So what this diversification means for the Asian REIT market is that it lowers the volatility of the sector. To begin with, the correlation between the underlying economic drivers are fairly low, but also when the Asian REITs were set up, there was a very strong governance framework that was set up along with them. There's legislation in place around limitations on gearing. There's limitations on how much the REIT has to pay out in terms of a dividend to investors. And in some countries like Singapore, they have to pay out 90% of their income to investors. And what that means for us is a very stable income stream. The yields that we get out of investing in Singapore REITs are circa 6% at the moment. And so the lower volatility that comes from this basket of Asian REITs is actually lower than what we see in other REIT markets around the world. They're less volatile than the US REIT market, the European REITs, and the Australian REIT market as well. And so we feel like the Asian REIT market is a very it's a very passive, safe way to get exposure to the growth tailwinds in Asia. The income stream that the REITs pay out as dividends is predictable. It's born out of passive rent collecting activities that these REITs undertake out of owning office buildings, shopping centres, industrial buildings, etc. And so, as income investors, we really value the stability and the predictability of that income stream. We look at the lease terms that range from 2 to 20 years. We look at the covenants that back these leases, very similar to what we see in Australia. The multinationals, the big law firms, professional services firms, etc. And that's why we are very comfortable with the income stream that come out of these Asian REIT investments.